Getting approved for a high-limit credit card isn't just about luck. It's about understanding how credit works and positioning yourself as a low-risk borrower. What you'll learn in this video are the factors that influence approval decisions and how to optimize your chances of success. From credit scores to income, debt, and history, we'll cover it all. Plus, I'll share insider tips like the best time to apply and how to leverage existing relationships to get the highest limits. So, if you've dreamed of unlocking premium travel perks, cashback, and credit, keep watching. By the end of this video, you'll know exactly how to make your high-limit dreams a reality. You won't get approved for a high-limit card unless you have excellent credit. Card issuers want to see a score in the good to excellent range, usually 700 or above, as you're less likely to miss payments and carry a high balance if you have a higher score. That doesn't mean you won't get approved with a lower score, but your odds will be much lower. And even if you do get approved, you'll probably start with a lower credit limit. On the other hand, if you have an excellent score, 800 or above, you'll be seen as extremely trustworthy and qualify for the highest limits. You can check your credit score for free from Credit Karma, Credit Sesame, Annual Credit Treat, Calm, or by contacting the credit bureaus directly. If your score isn't where you want it to be, take the time to improve it before applying for a high-limit card. Ways to boost your score quickly include paying down credit card balances, paying all your bills on time, disputing errors on your credit report, and becoming an authorized user on a responsible family member's account. High-limit card issuers want assurance that you can repay your borrowed funds, so they'll review your income thoroughly. Generally, you'll need an annual income of at least 6 figures to qualify for a high-limit card. Some premium cards even require $100,000 per year. However, there are a few issuers who cater to those with lower incomes. For example, Discover and Capital One tend to be more lenient and approve applicants with lower income. In terms of your debt-to-income ratio, or DTI, aim to keep it below 36%. Lenders like to see that your housing costs, auto loans, and other debts don't consume too large a portion of your monthly income. To calculate your DTI, add up your monthly debt payments, including the proposed high-limit card payment, then divide by your gross monthly income. It's not enough to just have a high income. You also need to demonstrate consistency. Lenders want to ensure you have steady employment and income over time, not just a sudden spike in income followed by unemployment. While some high-limit cards only require you to be self-employed for 2 years, others require 5 or more years of business experience. The longer and more stable your work history, the better. Even if you recently changed jobs, your credit history still matters. A positive credit history boosts your credit worthiness. Lenders want to see that you've made on-time payments consistently and managed credit responsibly over an extended period. A longer credit history generally leads to higher approval odds, especially for premium cards. However, if you're new to credit, don't worry. You can still build your history. Consider becoming an authorized user on a family member's account to gain access to their positive credit history, or opt for a secured card to start building your own track record. Now let's talk about the types of credit history that lenders look for. First and foremost, they want to see consistent on-time payments. This shows you can be trusted to repay your debt. Missed or late payments, on the other hand, can tank your approval odds. They also want to see that you use a variety of credit responsibly, like credit cards, installment loans, and lines of credit. Having different types of credit in your mix demonstrates that you can handle various forms of borrowing. Finally, they want to see credit that has been established and used for a long time. Your oldest account should be at least a few years old and show consistent, responsible use. In addition to your credit history, they'll also analyze your credit utilization rate. This is the percentage of available credit you use. Aim for a rate below 30%, and ideally under 10% for the best results. High utilization suggests you may be overly reliant on credit and struggle to pay your balances in full. To calculate your credit utilization rate, divide your current balances by your total credit limits across all your cards. For example, if you have $1,000 in balances and $10,000 in limits, your rate is 10%. Keep this number low by paying your balances down below 10% before the closing date each month. You can pay down your balances by making extra payments, transferring balances to other cards with lower interest rates, or using the cash or debit for purchases until your balances drop. Before approving you for a high-limit card, issuers will check your debt levels. High debt, especially revolving credit card balances, can signal that you're already maxed out and may not be able to handle a higher limit. Lenders want assurance that you can repay your new charges while managing existing obligations. You'll fare best if your balances are low relative to your income. As a general rule, aim to keep your overall credit utilization below 30% and preferably below 10%. You'll also want to watch your debt-to-income ratio, or DTI. Lenders like to see a DTI below 36%. This is the percentage of your gross monthly income that goes toward debt payments, including the proposed card. Calculate your DTI by adding all your monthly debt payments, including the new card payment, then dividing by your gross monthly income. You can reduce your DTI by paying down balances, increasing your income, or decreasing monthly expenses. Your credit report contains valuable information about your credit history, including payment patterns and credit utilization. Before approving you, lenders will thoroughly examine it for accuracy. They'll check for any negative items like late payments, charge-offs, or bankruptcies, as well as positive indicators like on-time payments and low credit utilization. You'll have the highest approval odds if your report is clean and comprehensive. To prepare your credit report, check it for accuracy and dispute any errors. Mistakes happen and can negatively impact your approval odds. Look for any inaccuracies like accounts you don't recognize, incorrect payment dates, or duplicate entries. You can access your reports for free from the major credit bureaus TransUnion, Equifax, and Experian. Dispute any errors with the credit bureaus. You can file disputes online by calling or by mail. Provide documentation like account statements or emails to support your case. Once the bureaus investigate and correct any mistakes, your score may rise, boosting your approval odds. Another way to position yourself for approval is by establishing a strong relationship with your chosen lender. Banks often have more flexibility than card issuers and are more willing to overlook minor issues like a slightly lower credit score or higher. DTI: if you're a long-term customer with a solid track record. Building a relationship involves maintaining active accounts, using their services regularly, and demonstrating responsible financial behavior. If you already have checking, savings, or investment accounts with a particular bank, mention this when applying for a high-limit card. They may view you more favorably, since you've already shown reliability by meeting your obligations on existing accounts. Additionally, consider applying for the card in person at your local branch rather than online. You can speak to a banker who can potentially make decisions or advocate for you internally, leading to a faster approval or a higher limit. Knowing when to apply is also crucial. Time your application strategically to increase your odds of approval. For instance, you'll fare better if you apply when your income is stable, your balances are low, and your credit score is high. Avoid applying for multiple cards at once, as this can signal desperation and hurt your score. Each application involves a hard inquiry that temporarily lowers your score. Also, try not to apply for high-limit cards when you know there will be major changes coming up soon, like a new job, wedding, or big purchase. These can affect your approval odds as lenders view these events as potential financial risks. If you're unsure when to apply, consider using a pre-qualification tool first. Most card issuers offer this option, which allows them to do a soft pull on your credit, which does not impact your score. It gives you an estimate of whether you'll be approved and the card's potential terms, helping you avoid unnecessary applications. Remember, being pre-approved or pre-qualified is not a guarantee of final approval. The lender will still perform a hard inquiry and review your finances before making a final decision. In conclusion, getting approved for a high-limit card is achievable with the right preparation and commitment. Maintain a stellar credit history, diversify your credit mix, keep credit utilization low, manage debt responsibly. Establish a strong relationship with your chosen lender, and time your application strategically. Follow these steps to put your best foot forward and unlock the benefits of high-limit cards. Remember, status and luxury are within reach. Good luck on your journey towards earning elite credit.